In this recording, we're going to look at a couple of topics. One is LIFO reserve, and what does that mean? Well, I'm going to go back to problem 6 that we went over in a prior recording, and let's just compare. If we were using FIFO for costing our inventory, we would have a balance of $29,900. Now, what if, that's for internal, but for external purposes, we wanted to use LIFO? Well, the difference there would be $12,500. That $12,500 would be called LIFO reserve. Again, LIFO reserve. It's really just the difference between our internal records and then if we were reporting, or when we report using LIFO reserve. Using LIFO. So it's just the difference. And by the way, if you took the difference in the two cost of goods sold, you would also get the same number, $12,500 difference. So we have a higher cost of goods sold using LIFO. Okay, so that's just explaining what LIFO reserve is, and we can just sort of track that without actually using it in our internal records. Now, I want to move on to dollar value LIFO. That's the second topic of this recording. The problem with using LIFO is that it gets into a lot of detailed record keeping, but also if inventory shrinks, so let's look at LIFO here. If it went from 1,300, let's say down to 900, that there were only 900 items left. Well, if there were only 900 items left, then all of this $318, and then another we would be going down 400 units. So 300 of this would become part of cost of goods sold, and 100 of these items, 100 of the beginning inventory at $12 would also be included in cost of goods sold. Now notice, our most recent purchase was at 23 over here. So if inventory shrinks, then these small dollars get put into cost of goods sold. And if we have a small cost of goods sold, that's going to increase our profits. So again, all of this is cosmetic, but it does give the impression of higher profits. And if we have higher profits or higher income, we're going to have higher income taxes. So that's also considered somewhat a disadvantage of LIFO, is if the ending inventory shrinks, then you don't get the normal advantage of LIFO with smaller profits, right, over where we had smaller profits. Instead, profits will go up. So as a way of sort of circumventing that, we have this other method called dollar value LIFO. And I'm going to use exercise 25, at least part of exercise 25, to demonstrate dollar value LIFO. So dollar value LIFO is going to, again, use the same LIFO concept, last in, first out, but instead of quantities, we're really going to price it in dollars. And so we end up using these price index. It could be the consumer price index, that's an external price index. We might even create our own internally. Your textbook adequately covers that whole idea of, where do we get the index? It could be externally generated, or it might be something we develop our own. Anyhow, in 2011 is when this company first started tracking LIFO. So we have $80,000. Given that's the base year, the price index is going to be 1 because that's our base year. So we would have $80,000 of inventory for base year, and there is no change from prior years because this is the first year. So our ending inventory at base year prices is $80,000. And again, and also that's going to be at a LIFO basis, so $80,000. Now let's go on to the next year. And the next year, prices went up. So our price index, what was costing us $1, now it costs us $1.05. So if our ending inventory is at $115,500, all I'm going to do is divide by that 1.05. So I'll take my current dollar, divide by the price index of 1.05, and I'll get a base year of $110,000. And again, these are in dollars, $110,000. So that is a change. We went from $80,000 to $110,000. That went up $30,000. And again, we are looking at it in terms of dollars. So it went up 30,000. So we now have two layers for 2012. We have the 2011 layer at 80,000, and we have the new layer of 30 grand that was originated in 2012. So again, total dollars of 110,000. And you can always check, what you have as base year should equal the total of your layers of 110,000. Now we're going to convert them back using the base layer, using the price indexes. So this 80,000 had a price index of 1. So that's going to have $80,000 when we extend that over. But the 30,000 had a price index that was created and generated. That new layer was created in 2012, so it has a price index of 1.05. And when I extend that over, that's 31,500. So if I add those up, my dollar value LIFO is going to be $111,500 for 2012. So again, it's like we have two layers, one from 2011 and then the other layer from 2012. Okay. All right, let's go to 2013. So again, I take the 108,000, divide by, again, we're in a period of inflation, so the price index went up to 120. So now we have, if I divide that 108 divided by 120, I'll get 90,000. This time I compare the 110 and the 90, and we see we have a decrease of $20,000. So when I go down here to figure out my layers, I have to figure out, okay, if it went down 20,000, which of these two layers do I take it out of? Well, it's LIFO, last in, first out. So I want to take it out of the last in. So in 2013, again, we'll have two layers, but that 20,000 is going to come out of this 30. So 30 minus 20 gives us 10. So only 10,000 of it is left. And again, I'll end up with $90,000, and that agrees with my base year. So my layers total up to the 90,000. Okay, then I just assign the 80,000 came out of 2011, so that's $80,000. And this second layer came out of 2012 at 1.05 for 10,500. So 90,500. And again, so we have our two layers, 2011, 2012 went down, that layer was depleted some in 2013, and there is no layer for 2013 because inventory didn't grow. I'm only going to do one more year, although the problem has more layers. Let's go to 2014. Again, divide the price index into the current price. We'll get 94,000. This time we went from 90 to 94, so we have growth of $4,000. So now our layers are 80,000. And then 10. Notice we started with 30 in 2012 and now it went down to 10. This 4,000 increase does not go back into 2012. So my point being is, once you lose part of a layer, it's gone for good. You don't get to recover it. So only 10,000 left for 2012 and then 4,000 for 2014. And then I add those up and I get $94,000. And that agrees with our base year over here. Then I take that times my price indexes for each year. For 2011, it was 1. For 2012, 105. And for 2014, this 1.3. And then just extend those over. 10,000 times 1.05 is 10,500. And then 4,000 times 1.3 is 5,200. And that'll total 95,700. 95,700. So we have our 3 layers from 2011, 2012. We don't have a layer from 2013, and we jump to 2014. Okay, so what we've saw for these ending amounts are what we would see on the balance sheet. This is what we would see on the balance sheet for ending inventory.